Hi friends. Well, lots is going on right now in the banking sector around Silicon Valley Bank and Signature Bank. What does it mean? Is this the tip of some bank failure spear, the domino that is falling, or is this the straw that has broken the financial or economic system's back? No, 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 and definitely not. What you have here really is a mismanagement of a balance sheet. Signature Bank and Silicon Valley Bank were two very niche banks. Silicon Valley Bank, as you probably know, lent to venture capital firms, startups, and tech companies. But they also managed their balance sheet, their hundreds of billions of dollars in assets, in a way untraditional, and now we can clearly see risk on way. In fact, of the banks that were studied, the large banks in the country, Silicon Valley Bank had more of their assets exposed to market sensitive investments, including equities and bonds, than any other bank in the study. Signature Bank, which was seized this past weekend by the Federal Reserve and lost their state bank charter, was a predominantly cryptocurrency bank. And the volatility in that sector created unrest for both of these banks. Silicon Valley Bank had a large portion of their assets in long-term bonds. Well, as you may know, last year, bonds and fixed instruments had their single worst performing year in recorded history. So if Silicon Valley Bank had $1 and they had the choice, do we want to earn 50, 75, 100 basis points at the Federal Reserve deposit rate, or do we want to try and get a little more juice for the squeeze and earn 3.5% or 4% on our money in long-term bonds? Well, that's more than just a math equation. There's a lot of risk that goes into that. Because remember, when you invest in a bond, as long as you hold your money until it matures, then you get your money back. But if you go to exit that bond prior to its maturity date, it's whatever the market value is. Well, as interest rates skyrocketed last year at a faster clip than any 12-month period in Federal Reserve history, those bond values went down. So literally, Silicon Valley Bank watched day after day, week after week, month after month, their balance sheet deteriorate because of bad investment selection. Well, you couple that with a large outflow, you've got an issue. You've got insolvency in this case. Let's be clear. We have no belief, no indication, and it is absolute fear-mongering to suggest that our economic system, our banking protocol, or any of the other major economic institutions are at risk or are going to have a contagion effect from either one of these. This is bad management, poor investment selection, and risk on in an area which simply should not have risk taken, and that's the banking system. So the Federal Reserve has stepped in, has ensured all depositors are going to get their money back, and this is not the beginning of any kind of issue in the economic or banking system. We have issues. This, not one of them. Thanks for watching. See you next time.